I'm more than happy to welcome you here to panel discussion on real estate finance. So we have gathered today here to delve into dynamic world of real estate finance, to explore the latest trends, to discuss the challenges we are facing nowadays, especially I would say the challenges related to high rates, inflation, war in Ukraine, and many other difficulties the market is facing now. And we have assembled here a very prominent panel of experts who bring their expertise, their knowledge in the field of real estate finance. And as we were joking with the gentleman before the discussion, you know, somehow I have a small feeling that one of the reasons I was invited by the organizers to moderate the discussion is to dilute a little bit this prominent company of gentlemen, gender-wise. So nevertheless, I encourage our panelists to engage into thought-provoking discussion, to share your expertise, to provide very practical insights that our audience can benefit from. And you, dear audience, you are more than welcome to give your question, to raise your question. You know, the link has been supposed to be on screen, but I think you remember, so I will try to ask as many questions as possible, taking our time frame into account. And also, special thanks goes to Oleg, and I would like you to give him a round of applause, because just this morning we were aware of the fact that Vlaho is not coming, and I has just caught Oleg together with Per drinking coffee and persuaded him, you know, to also present a little bit EBRD things today. So, without any unnecessary delay, I think we can start our discussion, and you know, I would like to start with a generic and backward-looking question. So, the European Central Bank has raised interest rates like 6 times since the last July. Of course, the target was to rein in the inflation. So such rapid tightening in credit conditions, of course, has triggered the volatility on financial markets. And what do you think? Like, how has the real estate finance landscape evolved over the past year? And maybe what are the key trends shaping the industry today? So who would like to start? Yun, you?
Yeah, I can start.
Okay, thank you.
I think first of all, we need to see that, okay, rates have gone up in all markets, more or less. And of course, that increases the cost. But I'm not sure that that is the same thing as credit, conditional credit tightening in that sense. Because it's very different depending on what market you're active on. If we are, for instance, in the market in the country that then lost in the quarterfinal towards Latvia, there you had an asset inflation for many years. And not sure it's an asset crisis that we have at the moment, because I think the assets as such will be there. It's not a banking crisis, because banks many years ago stopped focusing on the value and started focusing more on the cash flow. But it's owners that are over-leveraged and companies that are over-leveraged in many senses.
Okay.
If you're here in Lithuania, but also in Estonia and Latvia, it's quite different. Yields never compressed in the same way. And we also all know that there is a huge need for transformation, both on the private mortgage market or residential market, also in the commercial market. So if you look around and if you're focusing on sort of modern, flexible, energy-efficient offices, I think there will be a good market for that going forward, and I think that banks are also very much willing to be participating in that. And the same if you're on the residential market, there is a need for new houses or to renovate and energy-efficient other houses. So we need to look at it very differently on different markets, and I think banks also will act differently in different markets depending on the conditions. So here I'm quite positive, actually.
Okay, nice. Okay, we will discuss the various jurisdictions and various possible financial conditions later a bit. And maybe, Per, you have something to supplement?
I think this was very good to start with Lars' presentation about the interest rates, because that, to me, is one of the key questions right now.
Okay.
And I would agree with what John said. I think the situation in the Baltic countries is quite different to compare what we see in Sweden as well, where the commercial sector is under significant or pressure. But I think, as Lars pointed out, there is some kind of risk scenario that these central banks still have to do more. Unemployment is not coming up. That's good for all the individuals, but how is that for the central banks? So, there is still a risk scenario that rates might go higher. I still hope that we can stay at somewhere around here, but you can't exclude the more difficult. I think these central banks are also a new operating environment that they haven't seen before, so they are also uncertain. So I think, this is a key question for all assets, not only real estate, but equities and bond and things like that. So, and personally, I think we're back to I'm old enough to have seen 500% central bank rate in Sweden. So for me, the last 10 years of zero interest rates and so on were not normal. I think we're going back to normal, and I think that will have its impact on commercial real estate and many other asset classes, actually.
Okay, thank you. And maybe to go even deeper to what Per and Jon has just said, I have let us call this official numbers of ECB. So what ECB staff now see is they are saying that inflation averaging at 5.3% in 2023 this year, 2.9 in 2024, 2.1 in 2025. And what they're also saying is that the interest rates were not yet, and maybe still are not yet, sufficiently restrictive to get inflation down to ECB target, which is 2%, of course. So should this suggest that more than one additional rate rise could occur? Maybe some of your insights, Lennart, you?
I think we're seeing the bulk part of the interest rate coming from ECB so far. So another 25 basis points or 50 basis points, I don't think that will move the dial very much in the financing of real estate. I think to add what has already been said here, there are local differences in the real estate market. Baltics seems to be very, very different from the Swedish market and the Norwegian market, where in particular in the Swedish market, there has been a trend where bank financing have been displaced over the years with bond financing, and right now the bond market is in terrible shape in Sweden, and to some extent also in Norway, and that creates challenges for real estate developers and for in particular for new builds.
Okay, any comments?
Sorry, it doesn't work.
Sorry,
Yeah,
can you hear me?
we can hear you.
Just a couple of things. I guess the panelists have covered, let's say, the main themes. But because we are not a purely senior debt lender, so we see things in different parts of capital structure, and also we see things in markets like Poland or see it in general. And simply put, the math hardly works now. So you have Euribor, you have higher margins. You have higher than 2% margins for investment grade debt, and it's not secured, but still, it's quite a change. And when you look at the projects and you compare this to 12 months ago, and it's very hard to just wrap your head around it. And also the loans have to be paid down, whether it's 30-year amortization or 25-year amortization, still they have to be paid down. And even now, senior debt, we can afford to be selective, but still we have our volume targets. The Baltic is very important for the bank. And we just struggle together with the sponsors. We struggle and also invest in bonds. So we see those pricing marks coming from the capital markets, and then we have to price the senior debt, and it's a logical disconnect, and then we invest in funds and how to make that work. I'm saying very general things, but I have to say, compared to 12 months ago, or probably the last conference, which I didn't participate in, unfortunately, I see there is quite a bigger shift. And I'm not here to, let's say, comment on the forward curve or where Euribor will land. I just don't know that. But, I mean, clearly it's a very challenging time. And I'm happy to go deep on project-specific kind of, let's say, points. But this is what we are seeing, and it's for senior debt, for co-investments that we look at, fund investments and bonds.
Okay.
Yeah, no, but I think if you look at the rates going forward, I think going back to Lars' presentation, that central banks have been a little bit off timing-wise. And I think there are also many of them old enough to actually remember what persistent inflation creates. It will make us all less wealthy. It may get all more poor. So since they were off timing, even if I think, Lars, you were right sort of in your forecast where rates will be, they will not take that risk. They will hike rates a couple of more times, at least in Europe and in Sweden, and then they will stay with those rates until they have full evidence that inflation has come down, not just that it has peaked. And they would rather run us into a more recession. We have technical recession already in several countries, but they will take that risk rather than missing out on curbing the inflation. So our forecast is 25 bips in June, now in a week, and then another 25 bips in July, and then that it will stay there. And then quite rapid decrease of rates during next years when inflation has come down. If it's right or wrong, no, but they will not make the mistake to get persistent inflation.
Oh, thank you. Okay, so I would like to take a little bit U-turn. You have already touched the, Swedish situation. We've mentioned Poland and Baltic states. So let us discuss a little bit and touch the competition between jurisdictions as well. So recently, what we have observed in Baltics, especially in Lithuania, is that Lithuanians are treating Poland as a very attractive country for investment, especially talking about real estate. So could the reason be such that financing conditions there are more favorable, for example? So maybe Lennart, you this time would like to start, or
yeah.
Okay.
Yeah, same from our perspective. Like we are a bank, we can't really see that is any difference between Poland and the Baltic states for that sake. I mean, I trust the investors, they do their mathematics correctly, and they go where they see the return and the risks are balanced.
Mm-hmm.
Well, I met some clients who have exposures in Poland. I don't think I've heard the argument about financing conditions. They could be there as well, but rather hear the arguments that, bigger market, higher yields, bigger cities, more international tenants, easier to create a scale, and so on. Those are the arguments I have heard for going into Poland rather than financing conditions. Financing conditions could be as well, but that's not the main argument that I have encountered.
One of the components, not the main reason.
Maybe, yeah.
Okay. Oleg, if you let me, I would like to assign one question especially for you. Could you please kindly elaborate on EBRD plans on reconstruction in Ukraine's infrastructure after war, and especially talking about electricity and railway companies and also real estate in broader sense?
Well, it's quite a question.
Yeah,
I will
is.
quickly comment on the Polish question before, because we do a lot of business there.
Okay.
And frankly speaking, financing is not definitely the reason. And I would even say that financing-wise, the Baltic markets might be even better off compared to Poland, because for certain product types, let's say residential for rent, those leases are zloty denominated, so you can't really get euro denominated financing. So you are being subject to local rates like WIBOR. and this is much more expensive. So in a way, it has to be something else, like the depth of the market, more investors you have, let's say, I mean, sorry for stating it, obviously it's just hard to compare. It's just very different story. Specifically about Ukraine, we are actually doing it now. We are not waiting for the war to stop or for some kind of ceasefire solution to be found, whatever that might be. I am from the real estate team, so I will be focused more on that. The bank invested last year, since the beginning of large-scale hostilities, 1.7 billion euro, which is probably like huge by any standard. Most of it, there was no single real estate project because there were specific priorities, and they were along the lines that you mentioned: power networks, railroads, food security. And it's not my sector. I don't have the details in front of me, so difficult to give you more color. But this year, we finally managed to close our first real estate project, which I'm personally very proud of. We closed a joint venture investment with one of the leading sponsors, Dragon Capital. I know some people in the room know them, and it's a big player.
Okay.
And it's an industrial logistics development. It's in Lviv, which makes a lot of sense geographically because it's western part of Ukraine. But still, I would consider that a very brave move because you cannot insure that property, for example. And definitely prospects of successful investment are, I mean, you can make a number of guesses. Going forward, now, because we also, I mean, the investments that the EBRD makes in Ukraine, they are at least partially supported by our, let's say, shareholders directly, for example, United States, European Union. So we have to follow pretty closely the guidance we receive from our sponsors, those donors who provide that additional funding or guarantees to support the investment volume. And those donors have their specific targets. So real estate hasn't really become like a very, let's say, focal point. But we are working on that, and hopefully this year we'll move forward with industrial logistics, but not only Western Ukraine, but also Kyiv region, residential, and maybe even some retail. So that's what we're looking at. But residential is a puzzle we are currently solving, and we haven't found a solution yet.
Okay, thanks. I'm just referring a little bit to organizers. So could it be so that I have like 0 question from audience? So either audience likes my question and is not asking theirs, or I'm just not receiving them. So, okay, so let's then proceed with what I have prepared. And I've got like a provocative question to you, gentlemen. Have you already noticed that bad assets portfolio is being formed because of either recession or not recession, because of expensive debts and many other reasons? And what could be like the percentage of your portfolio is non-performing assets? So maybe you can comment on this.
You start, John.
So your colleague is letting you be the first.
Thank you. I'll remember that one. No is the answer.
Okay.
We don't see that. And I mean, you saw that we reported our Q1 report some time ago. That is not what we are seeing. And also going back to what Lars presented, I mean, we are not in that kind of crisis. We might see some issues in some markets, but generally, people are still having a job.
Okay.
Unemployment is, I mean, it's more or less all-time low if we are talking about Estonia, Latvia, and Lithuania. But also in other markets, corporates are actually trying to retain the competence because they know how hard it is to get it back. And companies are doing generally fine. And in this, I think also the key is that if you go back to the crisis before, then you've also had banking crisis at the same time, meaning that banks have contracted. And by that, we have not been able to be there and work with the owners to together try to find solutions for companies that might be in difficulties. Now, banks are standing strong. So, I mean, we're not acting like that banks did in 2008 and also back in the banking crisis in Sweden that we had in the early 90s. Okay. So, even if we should start getting more both private and corporates in trouble, then I'm quite sure that in most cases, banks and the owners will together try to find solutions. I mean, it's not only so that the banks will solve it, but together with the owners, we can solve it. But we're not there yet, and that's not in our main forecast. But of course, risks are on the downside at the moment, so we are not excluding it. We're preparing for it, but we're not planning for it.
Okay, nice. So, Per?
No, it might be a repetition.
Any figures?
Yeah, well, I can, yes, public figures, listed company. So I think, you know, for the group, we had not the impaired portfolio, but we have expected credit losses. Q1 were 4 basis points on the group level. That's a very low number. I think it surprised many analysts. That goes for the whole Swedish banking system, that I think the expected credit loss levels that have been reported are much lower than I think bank analysts thought. Our number for the Baltic division, which is also a public number, was 9 basis points. So it's higher than Sweden, but you know, we feel very comfortable with our portfolio, and also because of the merits that we just discussed, we think the situation is slightly different, but at the same time we're humble. I mean, we have a uncertain situation, so far so good, and I think many things point that it will be that way, but it's an uncertain situation, so we're humble about it.
Okay, and any differences in between Lithuania, Latvia, Estonia, and Sweden in that respect?
Well, I mean, overall, I don't have, no, it's more or less the same for us in all the 3 Baltic countries, actually. Yeah.
Thanks. And I can see Lennart is also engaging.
Yeah, well, I can comment on the larger corporation market. We are not at all in retail household exposure. And our NPL ratio is hardly measurable. We have been quite conservative over the years, and we are still quite conservative in our risk-taking policy. And within real estate market, I mean, there are internal ratings and internal models that increases provisions in our balance sheet, but we have seen absolutely no sign yet of any non-performing loans.
Okay, thank you. So to proceed, I would like, you know, I like to quote today the European Central Bank's official information, and here I have, I would say, a little bit pessimistic one or sad one, and I would like, you know, to hear your comments, gentlemen, on this. So the results reported by ECB in April this year in banks' lending survey, and those relate to changes observed during the first quarter of this year and the expectation for the second quarter of this year. So according to this survey, real estate developers' net demand for loans fell strongly in the first quarter of 2023, and the decline in the net demand was stronger than expected by the banks. And the, I would say, saddest part of the sentence is that it is the strongest since the global financial crisis. So it is what European Central Bank is saying. So what do you think, maybe Jon?
Yeah, I think that, and I mean, ECB also has a survey when it comes to sort of credit standards, so tightening credit standards, that is very strong. But I think you once again, it's not one market or everything is not equal. If we are further down south in Europe, we have many weak banks. So there are many banks that I think will have to be cautious at the moment, which reflects a lot of the tightening credit standards. And then you were onto the Swedish market, or both onto it a bit. I mean, there are various reasons for a large, harsh stop there. I don't really see it here at the same time. It has fallen, definitely, and we have seen new starts going down and so forth. But we also actually see some positive tendencies, both on the commercial and on the private market. So we see the sentiment is picking up a bit here. And I don't think that, at least if I speak for Swedbank, we have not changed our risk appetite or credit standards in any sense. But of course, both we and the owners, developers, I mean, of course, need somewhat bigger margins since the uncertainty is higher. So when you calculate a project, of course, regardless if it's real estate or a greenfield investment in some production facility, of course, in an uncertain situation, you need a bit more margin than what you needed before, but that is not the same as changing the sort of the risk appetite or anything. So I wouldn't say that that is fully here at the same time, but of course it has slowed down, but we see positive signs.
Nice to hear. SEB position.
No, I think it's nothing strange. I mean, the cost of development, the project has gone up tremendously because of the inflation, the war, and things like that. The outlook is uncertain, and rates have gone up, so it's more higher cost to take your mortgage or whatever you need to do as a private individual to buy a new apartment. So I think, unfortunately, it's quite a natural development in the short run, and nothing strange about it. So hopefully, with the less uncertainty and more stability and so on, we can see a turnaround. And I would say, yes, we haven't changed our lending standards either. But of course, we need to make sure that the customers have sufficient headroom. I think, I think many people think that we should, give as much debt as possible. But of course, if we give too much debt, then it's a problem for us. But we also feel that we have been bad advisors to the customers. I mean, we want our customers to be successful, so we also take some kind of moral responsibility to find sort of a balanced structure, and hope we'll find that going forward when the uncertainty goes down.
Okay, thanks. Finally, we have started to receive the questions from the audience, so thank you very much for this. And
I wanted to make a comment.
Yeah, okay, Vlaho, yeah.
Very quick.
Olga, yeah.
Because we definitely cannot say that the lending standards haven't changed.
Okay.
I mean, they de facto have changed. And also for the, let's say, mathematical reasons that I mentioned in my previous comment. So roughly what we're seeing that loan-to-cost, loan-to-value ratios have come down, maybe 5 percentage points. Once again, it depends how you calculate and how you look at that. And margins are definitely higher. And because the bank being the price taker and, let's say, following the local lending market, that's what we see from our, let's say, local lending partners, that development project at 70% loan to cost is no longer there. So it should be 65% loan to cost. And similar math kind of works. So there's probably partially an explanation why the loan volumes have come down, because projects can no longer support the same quantum of debt. Just wanted to say that we struggle quite a bit with this particular point, how much leverage you can give.
Okay, thank you. And I would like to proceed with a question, which, by the way, also coincides with the one I have on my list, and this is, of course, ECG-related question, which is, either hot topic or not. So you judge, but everybody at least talks about this. So the question: what do you see the future of sustainable finance for real estate? And just to supplement from my side, do you consider the financing conditions could be better for, green projects? Lennart.
Yeah, we have always done and financed the green projects, the green real estate projects.
Yeah.
And we were quite early out also starting to purchase green bonds that was issued in the market. I believe 2016 was when that was started. So for us, ESG has always, for a long time now, been part of the decision making for what projects to decide. And I believe it's the same for my colleagues here. I think going forward, what will support the market are the renovation needs, both in the Baltics, but even in our Nordic regions. The long-term renovation strategies that EU has put forward and each of the countries have put forward. There are so many millions of square meters that needs to be renovated that it's going to take, it's going to provide good opportunities for investors, good opportunities for banks to finance.
Okay. Any supplement?
Yeah, we started the green theme maybe 15 years ago, but not to compete with Nordic Investment Bank. Just the bank started it a long time ago, before it became sort of mainstream. So now we are roughly, let's say, in line with the market. So it's not challenging for our clients to meet what we call the green standards. Going forward, definitely the standards will be stricter. The certification levels that we currently accept and still qualify those investments as green investment will be stricter. One particular point to mention that we have a slightly different, let's say, logic of what we consider green or not green compared to European Union taxonomy, so which helps us with certain projects. And one particular challenge we also see on the horizon that, let's say, refurbishment, redevelopment of projects where you don't build from scratch, but it's difficult to, let's say, then certify at the same level, technically might disqualify some very meaningful projects from being qualified as green. And this is clearly what we will be working on, and because it makes a lot of sense to repurpose and not build from scratch.
Yeah, but I fully agree. I mean, there is a tremendous need for the transition, not at least here in Lithuania. And we have set out targets for Swedbank in the Baltics to reduce the CO2 emission for our property portfolio with roughly 40%. That will be done both by renovation of old houses, which we have focused on for a lot of years, focusing on supporting new build houses with the highest energy class. But it's also, and we have special offers for those, but it's also about sort of transforming the energy sector, which is not only from the environmental perspective, it's also from actually national security perspective. And this, I think, will drive a lot of the growth in the bank sector here for many years, because the institutional capital is very limited here. In many other markets, you have pension capital, you have other institutional capital, but that's limited here. So it will be banks together with other supranational institutions, youth guarantees, state guarantees, etc., that will be there. And this is definitely part of our focus going forward.
Okay.
I think all banks have a strategic interest to build up a book of green assets. I mean, we communicate this publicly to the market on the group level, the level of green asset ratio, our brown exposures, and things like that. So, of course, and I mean, in not only real estate, and I would, the conditions for green assets are better than for brown assets, if I may use that word. There are many parameters in terms of risk-taking and things like that, but my impression is that the clients always get a better deal for a green asset than for a standard asset.
Okay. Thank you. So, leaving a little bit ECG topic, we have very good, I even have the prediction who Kęstutis is from the audience. A good question from Kęstutis, designated, I think, to SEB and Swedbank, most of all. So when do you think you will be able to lower their margins? So, very straightforward. Kęstutis is asking.
What's the question? When we think we will be able to lower the margins?
Yeah.
I mean,
maybe you are.
I mean, there are lots of, very ongoing initiatives all the time. If you look at the mortgage market here in the Baltics, I think, and in Sweden, in some sectors, the margins are extremely thin in a historical perspective and so on. And of course, we see also credit spreads widening across the world. I mean, if you look at the bond market, the various reference points and so on. So, I think it's difficult to give a precise answer on that, but we do see pressure in
So the answer is, it depends. This is correct. Okay.
Well, thank you, Kęstutis. He's sitting here laughing, looking at us. But I think the key is that there are drivers going in different directions. On one hand, a world with positive interest rates is a world more aimed for our bank's business model. So that would speak for that margins would go down. But on the other hand, you have another trend which you touched on, which is sort of the risk premiums have gone up, which is very much seen on the bond markets and on other markets. So it's a little bit going in divergent directions, but I think margins have gone down a little bit over the past years compared to where they were, but the thing hindering it is sort of the risk premiums that have gone up. So hard to predict what will happen. Let's see.
Okay, so gentlemen, since we have like red screen watching us, and we have been reminded we have to be sharp on time, so just last sentence about the predictions for the next year. So imagine next year we're sitting here and we're discussing what, like the final takeaways for us.
I mean, let me start with saying that the risks are on the downside, so we are humble in that sense. But what I predict is that we have a rather slow year in front of us, but that we see the sentiment picking up. And as I said earlier, I think we have seen signs on that already. It's starting to get easier to predict construction costs. It's starting to get easier to predict where rates will top. Then the risks once again are on the downside. But I think those factors, in combination with the need for the green transition, both in the property sector but also generally, will mean that we see projects coming up more tangible again. So as long as things go according to what we forecast, then I think rather slow year that will start picking up and then gradually also continuing to pick up next year.
Thanks.
I think in our discussions with our clients, we would like, that there is headroom for this uncertain interest rate environment. I think also we would like to see asset selection. I mean, there are also things we haven't discussed here. The office, being in the office, not being in the office trend, that has an impact on the market. And then sustainability. I think very often when we talk about sustainability, we come from the doing good perspective, which is very good, but there is also a risk element that we haven't developed here, because you can easily categorize things in stranded assets and future-proof assets. And I think that's the risk element of selecting an asset that is, can cope with floods, extreme weather, and things like that is something that should be considered.
Okay, thanks. Oleg?
We'll keep it very short. So hopefully next year when we speak again, the repricing will have happened and no more negative leverage. And we can do more deals, not less.
And 2% inflation. Okay. Lennart?
My final word would be, I fully agree that uncertainty in the market is there. It's going to create a bit of a down year in the future now. But I think next year, sustainability financing for all three of us and four of us will be much more important than it is. And the focus on the companies and the sponsors, ESG, is higher than it is today. Thank you.
Thank you. It has been a pleasure. Thank you very much, gentlemen.
Thank you.